Okay, guys, let's go ahead and get started. I want to thank you all for being on the call today. We're going to talk about how you can make, on average, $81,000 by referring business owners to us. And this is a wonderful program for CPAs and tax advisors, accountants, bookkeepers, even P&C agents. In fact, I'm going to show you what the problem is and the solution. And I kind of feel like by the end of it, you're going to feel like you have an ethical obligation to talk to some of your clients about this. And the plus side is you get paid handsomely to do it. Now, you can actually show this to all your clients, but business owners is really, you'll see that they have a special advantage in their situation. And we'll talk about that all in a minute. But the topic is we want to show them a better way to retire. And first, we want to show you not just our opinion, but what others in the media are saying about the model. And the model is just not working, all right? A study conducted by Boston College Center for Retirement Research has found that American workers are $6.6 trillion short of what they need to retire comfortably. Now, according to one recent survey, 74% of American workers are expected to work even though they are, quote, retired. And 7 out of 10 Americans will retire with $60,000 or less. Guys, this is pitiful. Now, here's the thing you need to keep in mind here. If you do what everybody else does, you will get what everybody else has gotten. And it's not much. So we have to say there's something not wrong when the majority of Americans retire with so little. The question we need to ask is, can we expect different results if we keep doing the same things? Now, this is an interesting article by Bloomberg Business. And it says the tax treatment of the 401k isn't as advantageous as it first appears. For that reason, contributing the maximum amount may not be the best idea for all workers. In fact, economist Lawrence J. Kotaloff of Boston University and Jagadish Kochel of the Federal Reserve Bank of Cleveland argue that many workers would do better by switching contributions from their 401ks to other accounts. The problem is that while postponing taxable income gives you a break now, it raises your future taxes. And I'm going to show you exactly how that plays out, and it's going to stun you. Now, CBS Money Watch, the 401k has failed, let's admit it. It's time to stop pretending that the 401k can get us where we need to go. Who would have ever, when's the last time you've seen that in the news? It just doesn't get out. And these are the things, folks, in your line of business you need to know. Now, another Bloomberg, when times are tough, companies find cost savings wherever they can. Now some employers are doing away with a 401k match, a benefit once considered almost sacred. So a lot of employees are counting on somebody else's good faith and good charity for their retirement. And again, this is just another variable that's outside of your control. So, retirement is not something you want to place on the whim of somebody else. And we'll get into how so many of those things play out in just a second. This was a very interesting article from Entrepreneur Magazine that talked about it. The generation that first grew up with a 401k is now retiring. And their conclusion is the supposedly dependable 401k is not your best choice for retirement, not by a long shot. And the article is titled 13 Reasons Why Your 401k is Your Riskiest Investment. Now, who would have ever placed a 401k as a risky investment? And again, I'm going to show you how all these play out. Now, this one is almost hilarious. I love this one. CNN Money of 2013. Fidelity is sued by its own employees over their 401k plan. Now, this was a very interesting paragraph in here, or sentence. The Fidelity complaint comes on the heels of a wave of 401k-related lawsuits against financial firms and other companies that allege mismanagement and inappropriately high fees. Guys, a wave of lawsuits. I don't think employers understand that they could be sued by their employees. Do you? I mean, do you really think that that's what they had in mind? They're trying to do what's best for their employees. They want to provide a benefit for them, and they don't understand that they're being sued for it, and there's a good reason. Now, this concluded just last year, less than a year ago. Fidelity settles lawsuit. It was a $12 million settlement over its own 401k plan. And here's what they say here. In contrast, the typical 401k saver has less than $100,000 in their account, according to quarterly reports issued by Fidelity. Other companies have also been ensnared in legal battles over 401k fees and alleged mismanagement. Now, let's talk about why it's such a horrible plan, okay? So let's get into the nuts and the bolts of it. Because you retire in a 401k, and that's not just a 401k, it's an IRA, it's a 403b, you name it. You're going to retire with the most ruthless partner known to mankind in the United States, and that is the IRS. No, don't give yourself to the dark side. Stay away from the IRS, okay? Now, let's take an example here. Let's say we have a 31-year-old who just starts contributing to a 401k. They're going to put in $500 a month or $6,000 a year. The two assumptions we're going to make is the money grows at 7.5% growth, and they're in a 33 1/3% tax bracket. And again, no reason for this other than simple math, and you'll see why in a second. Now, when they turn 65, it will have grown to $1 million in their account, and they would have saved $2,000 a year, or a total of $68,000 in their taxes. Now, that's not too shabby, is it? I mean, man, that's why everybody loves an IRA or a 401k, right? You get the tax breaks. Now, let's make the same assumptions that the money's going to grow the same rate. That's only fair. And they're in the same tax bracket. Now, I've had a lot of people argue with me and say, yeah, no, we're going to be in a lower tax bracket. But you know what? For a lot of folks, they lost their two best tax breaks. The kids are gone and the mortgage is paid off. But there's a third reason that's even more striking and more powerful is our government's broke. And guess what? Taxes, do you think they're going to go up or down in the future? All right, we know they're only going to go up. I mean, it's a no-brainer. I don't know of anybody that would dare argue with such a thing. All right, so let's talk about what happens in retirement now. They want to live off interest only, not touch that $1 million. So they got an income of $75,000 a year. Pretty good, right? However, their partner shows up. Remember him? Now they pay $25,000. Remember, they did this because they saved $2,000 a year, and now they're paying $25,000 a year. At age 85, they will have paid $500,000 in freaking taxes, guys, and it could be more if there's estate taxes involved. So we got snookered. All right, we got snookered here because a 401k or an IRA, what have you, qualified money, tax-deferred money, it was designed by politicians for one reason and one reason only, increased taxation, okay? That's it. It's not for your benefit, it's for the government's. The question comes down to would you rather pay taxes on the seed or on the harvest? And obviously, when you retire with the IRS as a partner, you're going to pay taxes on the harvest. All right. ABC News, 401k losses, older investors' retirement funds hit hard. Alex Dudas, a manufacturing engineer in Torrance, California, who is 61, says he will now have to work longer before he can retire because his retirement plans are down about 43%. He estimates because of the drop in his 401k plan, as well as the value in his home, he's lost about $700,000. So guys, a lot of times this is a double whammy. When the market goes, a lot of home values go with it. So, doesn't always have to be the case, but it's often the case. So this is the reason that, oops, got to get that out of there. Time Magazine did an article in 2009 called Why It's Time to Retire the 401k. And this is exactly what they talked about. This was their primary point. They had a couple of them, but they didn't address taxation, which I was stunned at. But they talked about your money might not be there, just like Alex Dudas. So can you imagine this? You're paying into a 401k plan for 30, 35, maybe even 40 years. And when you retire, say the market takes a hit like in 2000 or 2008, and you have a couple bad years, your dreams could go up in smoke, or you're going to work a lot longer than you plan to, guys. Is that any way to plan your retirement? Again, it's look at the things that are outside of your control. Market risk is one of them, okay? Now, without knowing anything about anything, would you rather have your money on the red line or the blue line? All right, the blue line, of course, right? Now, let me tell you what the red line is. The red line is the performance of the S&P 500 index. Now, the S&P 500 index is the top most widely held companies in America, include, Coke, Walmart, Exxon, over 100 different industries. And this is the benchmark for which brokers want to obtain and which 75% of them don't. Okay. Mutual funds, 401ks, you name it. Your managed money, retirement funds will not do this good. 3 out of 4 won't do this good. So let's talk about what we know about the blue line. Well, obviously there's more money in it. It never goes down in value. You notice that there's no risk. It never goes down when everything else is dropping. It holds even. Now, it's a zero gain, and nobody's crazy about a zero gain, but look at the alternatives. Okay. Now, the third thing you can't tell by looking at it is this money's tax-free. Now, all of a sudden, that looks a whole lot better, doesn't it? Now, what this also means is in the red line, you've got to subtract fees and you've got to subtract taxes. And after you do that, guess where you actually are? You're going to be underwater. And I'll prove it to you right here. This is pretty interesting here. This is the red line and the blue line. So the red line is all the ups and all the downs. It's the 401k, IRA, what have you. This is an example I took of a 40-year-old male, $100,000 in each account. Doesn't really matter. And this side over here is a life insurance policy. It doesn't go any higher than 13%, which is nothing too exciting, right? But it doesn't go below zero. So let's see how this actually plays out the last 15, 16 years. The first year was 1999, and there was a 19.53% gain. And you'd see that's a pretty good gain in your money. They made $19,530. This side only gained $13,000. Not as exciting. But look here, the dot-com bubble came along, 9/11, 3 bad years. Their money is down $29,000 almost. On this side, it's still 113. Now, as you can see, it goes up 26%, only 13 here. Made the same amount here, same amount there, same amount there. Uh-oh, look at there. 10 years later, imagine having $100,000 in there. 10 years, you're going up and down this roller coaster. And 2008 comes along. We're at $167,000 on this side. Now let's see how it plays out the last 15 years. And we could go back 25 years, guys, and we'll have about the same results, maybe a little different. But I don't like to go back as far because, you know what, we're not going back to the days of 25 years ago. The 80s, they're long gone, just as long gone as the 50s and the 60s. We're not going back to that. The last 15, 16 years gives us a closer indicator of what we can expect in the future. So here's what we see. $167,000 when it's all said and done. And this is almost $304,000. Now, there's the rate of return. There's two numbers on the rate of return. 3.28. That's the real number that counts. That's how your money grew. But this is the number you hear in the news most of the time. They're going to say the stock market averaged over the last 15 years 5.04% interest. And that's true. That's playing with the numbers. That's just the numbers right here. But this is the side that really counts. And guys, that's really not any better than inflation. Now, everybody knows inflation is supposed to be at 3%, but it's really not. And if you do any grocery shopping, you realize it's not 3%. Because what politicians have done for years now is they took off food and they took off gasoline, the two things that really where inflation affects us, and they took it off. They put in there, they boogered with the CPI index. It tracks all these numbers. They put on there more stable things. But guys, anybody that's seen that 30% we had in peanut butter a couple years ago, or how value meal has gone from $1 to $1.30 in a year, is going to realize this is a joke to say inflation is 3%. So basically, all I'm saying is this money is not done any better than inflation, maybe even less. But we're not done, okay? Because we got to take off for fees and taxes. Fees, the LA Times says, is 3%. So we subtract money for that. And taxes may be generous, but we put it at 30% for state and federal taxes. When it's all said and done, look at there, that 401k, $100,000, 16 years later, they get to spend $81,000 of it, guys. That's pitiful. On this side, $266,000. Which would you rather have your money on? the red side or the blue line. Okay. Now, let's see where we are here. Okay. What we want to do next is show you a 5-minute video, a tax advisor called Ed Slott. You're going to really like Ed Slott. So let me go ahead and play just a 5-minute clip. I think you'll enjoy it.
Let's switch gears to another way to eliminate huge taxes: life insurance. Just so you know, I say it on every program, I do not sell life insurance. I don't sell stocks, bonds, funds, annuities. I'm a tax advisor and an educator. And as a tax advisor, I'm advising you to take advantage of the single big benefit in the tax code, and that is the tax exemption for life insurance. You've heard me talk about incredible leverage and tax-free benefits of life insurance, mainly for your heirs. And that payoff is big. You turn relatively small amounts of taxable money into a tax-free windfall for your family. They'll end up with millions more than you ever had, all tax-free. It's truly the best tax leverage available under the tax code, but it's actually better than you think, especially if you're thinking, what's in it for me? Anyone thinking that? In these volatile and uncertain times, you need to focus on investments that give you control, options, flexibility, and certainty. And you want to remove both stock market risk and tax risk. And you want a guarantee. And you want it all tax-free. That's a tall order. But you can get all of that with certain kinds of permanent life insurance. Most people think of life insurance as something that pays off after you're dead. That's true. But what if I told you that you could have tax-free access to your life insurance during your lifetime, so you could use it for yourself? You could begin moving large amounts of money from taxable accounts into a tax-free permanent life insurance policy. The money grows tax-free inside the policy. It's harder than ever today to make money on your investments. So the last thing you want to do is share any of your hard-earned gains with the government. You don't have to if those gains are earned within a life insurance policy. If your money's going to grow, may as well grow tax-free, right? You need to realize that life insurance is an investment, but it's better than your typical investment accounts because it's tax-free. Oh, and one more thing. Life insurance comes with something else that you can never get from the stock market: a guarantee. But how much can you invest? Well, that's up to you and the tax rules. Believe it or not, this is an area where you might want to invest the maximum you can into the policy. If you're approaching retirement or already retired and looking to shelter more of your taxable money into a tax-free vehicle, this might be the place for you. But the mistake most people make at this stage of life is trying to pay the least for the policy. So you might be thinking, how can paying less be a mistake? Everybody wants a good deal because this is an investment, not an expense. If you were saving money in a bank account, would you want to put in the most or the least? Of course you want to put in the most because this is your savings. You should look at permanent life insurance the same way, except that the investment is tax-free. So why would you keep money growing in a taxable account when it can be transferred to a tax-free investment? If you have taxable IRA funds, you can, in effect, convert your IRA to life insurance, pay tax now at low rates on distributions from your IRA, and then using that money to fund your life insurance investment. That accomplishes two things. You reduce your future tax exposure in your IRA by taking distributions now, and you build up a tax-free source of retirement funds should you need them. If it turns out that you don't need to tap into your life insurance for retirement income, then the life insurance benefit builds for your family. Also income tax-free, and for most people, it'll be estate tax-free too, depending on the estate tax exemption level. This is truly the best leverage available, and it's all under your control. Once again, I do not sell life insurance, but as a tax advisor, I've got to tell you that the tax exemption for life insurance is the single biggest benefit in the tax code. Make it a part of your retirement savings plan and your estate plan. But remember, this area of your life is a little tricky. You must do it the right way to receive all the benefits I'm telling you about. Now is the time to create a plan to rescue your retirement and move your money from accounts that are forever taxed to accounts that are never taxed. It's the taxes.
Okay, there we go. Ed Slott, you got to love Ed Slott. But I wanted you to hear it from a tax advisor and not an insurance agent, okay? But that should that should convince you guys. You talked about sheltering your money from taxes and from market risk. So just the same things I've been telling you. So let's kind of review some of the problems we've got with the 401k. Market risk. We've got taxation, which is huge. We've got hidden fees. We've got what happens if you die early? We hadn't really talked about that, but suppose you only die a couple years into your plan. You're going to leave somebody in a bind. You could get sick. Now, here's one that we don't really think about, but let's talk about this for a second. Today, new policies have what's called living benefits, where it pays you a lump sum when you get sick. Now, here's why it's so important. 7 out of 10 Americans are going to suffer a heart attack, stroke, or cancer by age 65. Guys, that's a little scary, isn't it? Now, the number one cause of bankruptcy today is still due to medical reasons, and 80% of those people are going to have health insurance. Now, how can that be if they've got health insurance? Well, it's not the bills that cause them trouble. It's not the medical bills that cause them trouble. It's being out of work, and you fall behind in the bills. It could be your spouse has to quit a job to take care of you, or you could end up having to go seek alternative treatment. A lot of things that may not be covered, but medical bankruptcy is still the number one reason. So what happens is a policy today will pay you up to 80–90% of the death benefit while you're still living, known as living benefits. And even term policies have them. So it's an amazing deal. You really ought to encourage people, ask them if they've got living benefits on even their term policies, because it's a big, big deal. All right, the last big problem with a 401k is you could run out of money. Another way of saying this is you could live too long. All right, that's kind of an odd problem to have, isn't it? How about if I show you an income that you can't outlive? Now, let's compare. What we're going to do is pull up a policy, and let me show you how it works. Well, let's go back. We're going to actually take this quote, a male, 40 years old, $100,000, but because they're going to have to pay taxes if they use it early, we're only going to be able to use half the money on this side. So that's what I'm going to show you. We took out $50,000. Now, remember Ed Slott talked about using an advisor because it's a little bit tricky, and this is what he's talking about. You can't dump in $50,000 on the first year. It's got to be deposited over 5 years. So this first 5 years has $10,000 extra in it on the first 5 years, and that's the $50,000. We're going to assume they're taking half of the money out of the 401k, and the other half is going to be left to pay the taxes. So, and then it's $200 a month, or $2,400 a year. So they keep, now notice first of all, a death benefit, $453,000. But we're really not doing it for a death benefit. We're doing it for income. Now, when they turn 66, they no longer pay, and now they're going to have $55,000 a year until age 120. As long as they live, guys. 55,000 tax-free dollars, still have a death benefit on top of it. Now, let's go back and see how the 401k compares. So here's what we're going to do. Hope everybody can see that. Maybe I ought to, does that turn out okay? I think that'll be all right. All right, $200 a month. We're going to assume they've got matching funds, so they're actually going to get $400 a month in there, and they've got the full $100,000. Remember, the life policy only had half the amount. We're going to start off with a historical rate of return of 3.28. We got that from right here, okay? And we're going to drop fees down to 2%. We'll give you a break. I'm going to assume they're retiring at 65. Now, they end up with $276,000, and guys, that's pretty good. I mean, it's a lot better than the average, right? But we want an income. This is what the IUL, the indexed UL policy projected, is $55,000 a year and 30% taxes. So here's what happens: they retire age 66. They're going to take out the income, $55,000. But then there's taxes, there's some growth, and there's fees. At the end of the first year, they get together. The husband says, "Mabel, we took out $55,000, but our account is down $76,000. Honey, we're going to run out of money in 3 years. We can't do this." And I see that a lot. I've got some Medicare clients, and they live like they're broke. And it turns out when they die, they had a nest egg. And you think, why didn't they spend that money? Well, you can see why. They didn't know how long they were going to live. They were afraid to use it. So they cut the retirement to the bone. So let's try increasing the rate. Let's make it the 5.04 like we see here on this number, and we'll see if that makes a difference. 5.04. Their money's grown to $385,000. Not too bad, right? But look at that. They run out of money in 1, 2, 3, 4, 5 years. It runs out of money. Okay, 5 years. Now, the life insurance policy is 7.2. So let's see what happens if they do 7.2%. Look at there, man, now they're talking about some serious money, $585,000. But look when they run out of money, 1, 2, 3, 4, 5, 6, 7, 8, 9, and the 9th year, they're out of money. Guys, so the 401k can't possibly hold up as well as the IUL does, the life insurance policy, because of taxes and fees. Those are the two main things there. So even if what we're doing here by increasing the rate of return is we're saying, let's just assume there's not as much risk. So we kind of eliminated risk, but it's the taxes and it's the fees that actually destroy the account. So they can't possibly compare with what we can. Now, let's pick up the end here. The life alternative, there's no market risk. There's no taxes, tax-free money. There's no fees. There's a death benefit. There's living benefits on it. Guys, you can't get much better than that. And an income you'll never outlive. All right. Now, it's a better plan for your clients, guys. For all your clients, you should be advising them, look, let's get you out of something so risky and get you out of partnership with the IRS. Let me tell you about a better plan. And guys, if you've just got regular family folks and you want to show them a better plan, tell them about me. We'll do a screen share. We'll split commissions. Your commission may only be $1,000 to $2,000, but we can help everybody, okay? And you and I can work together on that too. But we want to talk to you about 81 grand. It gets better for business owners. And here's why it gets better. And I'm going to show it to you. It'll be kind of exciting, I think, to you. The one problem we have with all kinds of money is the time factor. You're building little by little by little. And after 30, 40 years, it starts snowballing, right? Because they're a business owner, we can show them how to overcome that time factor by front loading it with a ton of money on the front end. And what happens is the contributions are tax advantaged, like a 401k. They get the tax break on the front side and tax-free money on the back. So let me tell you how that works. Let's get out of this and let's go back to this. And I'm afraid will have been logged out by now. So let me log back in. This is National Life Group LSW. It could be any policy. There's some even a little better than this. I just use them because they're really simple, easy to do a quote, and easy to explain on their. So here's what we're going to do here. We're going to pull up a business owner. We're going to assume this business owner is actually going to be 50 years old. Not as much time in retirement, but 50 years old, and they're going to say, you know what, I got to jumpstart my retirement. I'm not doing as well as I thought I would. A 50-year-old male, again, standard non-tobacco, so we could do a better rate for somebody that's in good health. Now, let me show you what we do. The business owner is going to dump in $1 million over the first 5 years. Now, let me tell you how this works. The business is going to take out a loan for $1 million, and the business is going to loan the business owner his own money back. And then the business owner is going to deposit that over 5 years. And actually, our average is closer to $2 to $3 million. But I just thought I'd show you $1 million because it's nice and clean, easy example to show you. So because it's a business loan, he's going to pay interest only for as long as he lives, about 3.5% simple interest. Remember how this grows on average? 7.2 compounded. So you've got a beautiful arbitrage here. 3.5% simple interest versus growth of 7.2 compounded interest. And so what happens is they borrow that money, they pay interest only until they retire. When they retire, they liquidate the loan when they sell their business. So it's just a liability that gets wrapped up in the sale of the business. So after that, they never put another penny in there. And let's see what happens when they retire at age 65. 281,000 tax-free dollars, guys, for as long as they live. Now, how many business owners do you know that would love to do this? All right. So what we do is we reverse engineer how much they can do. If they're paying $5,000 a month into a retirement fund, we'll figure it out what their payment would be. So it's a beautiful program because, again, the contributions are tax advantaged because it's under the business, and the distributions are tax free, and it pays on average $182,000, and I'm sorry, $162,000 on average. Now, all you have to do is make the introduction. I don't expect you to sell them. I'm the sales guy. You just tell them that there's a better way to retire without market risk, without taxes, without fees, that has a death benefit, pays them if they get sick, an outcome they can outlive. All you have to do is say, look, I need you to talk to somebody. Can you get on the phone for about 45 minutes to talk to them? And what we do is a split. Again, everything you and I can do together as partners is a 50-50 split. All right. So there's no who doing. We don't have to worry about if I pay you or not, because the check is going to come from the insurance company. Okay. You don't have to trust me. All right. You don't have to worry about it. Now, there's a catch, and it's got an easy solution, but there is a catch we have to talk about. Because we're talking insurance products, legally, you have to have a life insurance license, or you can hire an agent. And what that means is you've got to have a business, and your business can hire a life insurance agent. And what you do is you say, look, you run an ad in Craigslist, and you say, look, I'm looking for somebody who will write some applications for me, and I will pay you a flat fee. If it's a regular policy, you might say, look, I'll pay you $200 for every policy. If it's one of these bigger ones, so I'll pay you $500 every policy. And what happens is the commissions code to you. It's called assigning commissions, and then you pay that agent whatever deal you've worked out with him. So you will have a slight expense by paying that agent for every application he writes. So I do the selling. Both my name will be on the application, and either you or your agent's name will be on the application as well. So again, you don't have to worry about a trust factor, because I'm not writing you a check. The insurance company will pay you commissions. So somebody has to be licensed in that. That's the only catch that there is. So guys, that's really it. So if you're interested in this, contact me and let's get together. Let me tell you the success rate we have. People that get on the phone with me, 97% closing ratio. And I guess it's not really a closing ratio. 97% of them want to move forward because they've never seen anything like this before, and they want it. Okay, they want it bad because it's a no-brainer. Tax advantage on the front side, tax-free money on the back side, and a ton of money when they retire. And we didn't even talk about the look at this. A $3.7 million death benefit on top of it. Okay, what's not to love about that? Okay, so 97% of them want it. They may not qualify either if they're credit. They've got to have a decent. The business got to have a decent credit, and they've got to have, obviously, because it's a health policy, they've got to have decent health. All right, so 97% want to move forward. So guys, you have a wonderful opportunity. Your clients look to you for advice, or maybe you're in a position where you can talk to an owner, you're a bookkeeper, and you could get them by the arm and say, hey, listen, I'm aware of I work with a company that tells business owners how to retire with 2 to 3 times the amount of money in retirement. No risk, no fees, no taxation, death benefit on there, pays you if you get sick, and pays you tax-free money to age 120. Do you have a few minutes? Let me hook you up with this person. So it's really easy to do. I'll do the selling. We do the close. We work with their CPAs, by the way, because they don't know us and we're talking about a lot of money. Their CPA has to come on board with us, okay? So if the CPA won't sign off on it, we don't move forward. We don't want to be sued. We don't want anybody with accusations, and we don't have a single problem. We never do, because we get the CPA on board, and they love it. So that's it. If you're interested in making where is it? On average, oh, there we go, 106. Well, we split this, so the average commission between you and me is actually $81,000. 81 for you and 81 for me. That's the comp for selling business owners. So guys, if that interests you, please get a hold of me and let's help your clients out. Let's do the right thing by your client. Thanks for being on the call. Y'all take care. Bye-bye.